Hello and welcome back. Thank you so much for tuning in. I have a very quick update on the United States dollar, which is strengthening across the board as we are getting closer and closer to the Fed's potential rate hike in July. The market is now pricing in almost a 90% chance that the Fed will raise rates by 25 basis points at its next meeting in just 2 weeks. And that is contributing to the USD strength. But there is another very important fundamental factor that is driving the dollar higher, and that is escalating trade tensions. As you can see here, the US and China are tit for tat, raising tariffs on each other's exports. So starting today, additional 25% tariffs will be imposed on approximately $68 billion worth of Chinese goods. China retaliated last year when the US increased tariffs on Chinese imports. So this is not a new story. It's been going on for years. But here's what's really interesting. The US added tariffs on Chinese electric vehicles in order to make them less competitive. The goal was to protect American manufacturers from foreign competition. Right. Well, guess what? According to Reuters, the EV tariffs appear to have failed in their goal. In fact, the article says that China's BYD sold more EVs in the US than Tesla in the first half of this year. The article also says that the tariffs themselves may even be counterproductive because they incentivize US automakers to source parts from China in order to avoid higher costs. So the tariffs that were meant to help us automakers may actually end up hurting them. In any case, escalating trade tensions don't really benefit either side. It certainly doesn't benefit the US or the global economy. This is why investors often turn to the safe haven dollar in times of uncertainty. There are several other factors that contribute to the USD strength, including the recent jobs report that showed that the labor market is still very strong and the services sector is booming. As you can see here, the JOLTS report shows that job openings rose to nearly 12 million in May. There are simply more job openings than available workers. The number of people who voluntarily left their jobs actually increased slightly, suggesting that workers still feel very confident about their ability to find a new position. All of this means that the Fed may not be done with rate hikes yet. In fact, the market is now pricing in a 30 chance of a 50 basis point rate hike in July. Let's take a look at the yield curve. As you can see here, the 2-year Treasury yield is above 5. The yield curve is still inverted. In this case, the 2-year yield is higher than the 10-year yield. The difference between the two is 17 basis points. It has been much more inverted earlier this year, but it is still far from being normal, which means that the market still expects the Fed to cut rates by the end of the year. However, if the Fed keeps rates higher for longer, this expectation will have to be revised. Goldman Sachs just raised its end-of-year forecast for the federal funds rate to 5.6%. Previously, Goldman expected a rate cut in the second half of the year. Now they expect the Fed to keep rates unchanged. The market is not fully pricing in a potential July rate hike. If the Fed does decide to raise rates in 2 weeks, the USD will likely strengthen further. In addition to that, there is an increasing chance that the European Central Bank will have to raise rates even further than the Fed. Here's the updated ECB rate hike expectations. The market is now pricing in a 40 probability of a 50 basis point rate hike in July, and a 60 probability of a 25 basis point rate hike. This is according to the ECB forward guidance. Of course, what do you think? Will the ECB raise rates by 50 basis points next week? Let me know in the comments below. And if you enjoyed this video, give it a like and consider sharing it. Subscribe to my channels. I would love to have you back for my next one. And if you enjoy reading, find me on my blog for more weekly content. Thank you for watching. Thank you for staying tuned, and I will see you in my next one tomorrow. Bye for now.